Nigeria may have turned the corner with its monetary policy direction, and that's according to Goldman Sachs. Ghana is expected to achieve a 3.2% GDP growth in 2024. These are the talking points today on Business Edge. Welcome. I am Perpetual Fasnmi-Peter. Beginning with business headlines now, Pengasan, a Nigerian trade union, has announced an indefinite withdrawal of services and a shutdown of operations at the Nigerian Content Development and Monitoring Board, NCDMB branch. The action is a result of an impasse between the Honorable Minister of State for Petroleum Resources Oil and Chairman, Governing Council, NCDMB, and Executive Secretary of the board over the redeployment of management staff. Pengasan expressed concerns about the impact on its members' job security, monthly salaries, travel claims, and other approvals that enhance their welfare. The withdrawal of services began on March 12, 2024. The circular was signed by Comrade Benson Inifie, branch chairman, Comrade Simeon Esiekpe, branch secretary, and Comrade Yagwe Tubukimo James. This highlights the challenges faced by Nigeria's agricultural exports and the need for resolution to unlock the sector's potential. The Central Bank of Nigeria, CBN, is set to conduct a Treasury bills primary market auction on Wednesday, March 13, today. T-bills are short-term securities used by the government to raise funds and as monetary policy tools by the central bank. The upcoming auction will involve the rolling over of existing T-bills worth a total of 161.50 billion naira, with different maturities of 91 days, 182 days, and 364 days. Market analysts expect rates to remain stable, and the lower offer amount may impact investor participation. The CBN aims to manage liquidity and sustain attractive rates for investors. In the previous auction, the total offered amount was higher and stop rates increased across all offered instruments. The lower subscription level indicated tighter system liquidity. Ivory Coast market regulator has issued a warning to cocoa exporters against paying more than the set price for beans, threatening fines and license revocation. The warning comes amid the worst harvest in years in Ivory Coast and Ghana, leading to a 28% drop in Ivorian arrivals and record high cocoa prices in London and New York. The Coffee and Cocoa Council, CCC, noted that exporters have been overpaying for cocoa. The CCC also cautioned cooperatives and buyers against hoarding beans, mandating them to sell their stocks within 21 days. Despite the high global cocoa prices, the CCC plans to maintain its price scale for the upcoming mid-crop harvest. Italian energy company Eni S.p.A. has sold several of its oil permits in the Republic of Congo to Perenco. The divested assets, which were not central to any strategy in the country, were sold for approximately $300 million. Despite the sale, Eni continues to operate in Congo, focusing on the development of the country's gas resources, particularly through the Congo LNG project. This project aims to meet the country's power needs and fuel LNG exports, primarily to Europe. Eni made its first discovery in the Marine 12 block in 2008 and currently supplies 70% of Congo's electricity. The company is also committed to promoting energy transition in Congo, including developing agri-feedstock production for biorefining. These are the business stories we're tracking at this hour, and we go now to market update after this timeout. Stay with us. Fueled by bargain hunters, the Nigerian stock market surged 1.45% on Tuesday, adding 837 billion to its market capitalization, which now stands at 58.534 trillion naira. Well, let's look at the numbers, beginning with the all-share index. And looking at what we have for the all-share index right about now, the percentage change 1.45%, just like I said earlier, and then it's closed at 103,524.44. For market capitalization, we also see the same percentage change, 1.45, and then stopping at 58.53 trillion naira. And now let's look at the top gainers for yesterday's market. We have UBA closing 25 naira 30 kobo after gaining 10%. We have MTN Nigeria closing 243 naira 50 kobo after gaining 9.98%. And Julius Berger, we also have it there, 61 naira after closing 9.71%. Access Corporation 22 naira 45 kobo after closing, gaining 9.51%. And Veritas Capital 70 kobo after gaining 9.38%. And now to the top losers from yesterday's market activities. Tantalizers 35 kobo after losing 7.89%. We have NASCON 53 naira 70 kobo after losing 6.77%. Morrison that's 1 naira 41 kobo after losing 6.62%. C&I Leasing 3 naira 48 kobo after losing 6.45%. And we have QTix here 2 naira 53 kobo after losing 6.30%. Now let's see what the sectoral performance looked like yesterday. We have the financial services. We have both of them up. Yeah. So for banking, we have 5.36%, a lot if you ask me. And we wouldn't be surprised seeing some of the numbers with, some of the tier 1 banks. They actually moved what we have right here. Talk about Fugas, all of them. They did a good job there. And for insurance, 1.18%. For oil and gas, 0.12%. Oil and gas was unchanged for a long time. And now that we're beginning to see movements, it's just, it's not so much. For consumer goods, it lost 0.48% yesterday. And for industrial goods, that's it, 0.00. So that's what we have for the market update for today. We'll take a break now. When we come back, we'll start our first conversation for today. Stay with us. It's Business Edge. Glad to know you're still with us. A plummeting naira, skyrocketing inflation, and a lack of clear direction from policymakers. All these we have described Nigeria in the past few months. But analysts at Goldman Sachs are seeing a glimmer of hope, a significant shift in monetary policy. Has Nigeria truly turned the corner? Well, joining me to answer this question is Oladipo Ajayi, Head of Fixed Income and Forex at Chapel Hill Denham Securities. Thank you, Oladipo Ajayi, for joining me today.
Good morning. Thank you very much for having me.
All right, so this is a report from Goldman Sachs, and I would like us to begin with, the very first statement, if you open that particular report. And I know you have also talked about negative real interest rates during some of our previous conversations. It's something you've talked about over and over again. So I'm not going to bet, I'm just going to bet that you agree with this paperwork on that. So let us look at the part where it says the country is emerging from a period of monetary policy transition characterized by an absence of a credible policy anchor. Now, that is the part I want to get your thoughts on. Do you share the same thought? Oladipo Ajayi, if you can hear me, I was asking if you share the same thoughts with Goldman Sachs on this particular one. I mean, on the one hand, they've talked about how that the interest rate isn't encouraging for investors to come into the country, and that's why we're talking about negative, real interest, real returns, and all of that. And then on the other hand, they're also talking about some of the things they feel, talking about how that, maybe the policy, there was no anchor really for Nigeria's monetary policy before now. And I would like to get your thoughts on that if you can hear me.
Yeah, thank you very much. I so much agree with the report to a great extent. The mention of the fact that Nigeria is moving to moving to a more credible policy, it makes a lot of sense because they are looking at it from the angle that you can't perpetually keep monitoring or keep your rate stagnant while inflation is skyrocketing. You need to actually move rates. And if you also read the report, you will see where they actually mention the fact that for a long time now, the policy rate has become ineffective. And so it simply means that the monetary policy meetings all the while has been more like a tea party. So what they're trying to just highlight there is to state that truly the new CBN governor is actually working in stock. And you mentioned that his policy will be inflation targeting. He mentioned that it will actually move to a more flexible exchange rate compared to a peg exchange rate system where we're coming from. He mentioned he talked about greater transparency and across board many other things that he actually mentioned. And because of the fact that they're already seeing the impact of what he actually mentioned. And that's one of the reasons why JP Morgan actually mentioned that we are moving to a more credible policy.
All right, so I can almost assume that you're betting on the same metrics as the MPC decisions and even the last auction too, as signs Nigeria is turning the corner. I'd like you to speak a little more on that.
Yeah, of course, I spoke about this at, I think, on a program that I wasn't surprised with the 400 basis point rate hike. Of course, consensus based on Bloomberg is around 250 basis points. But when you look at the fact that there's been a pause on monetary policy meeting since the month of May. There was no meeting in July, there was no meeting in September, nor November. And January, we're supposed to have a meeting. We actually moved the meeting to February. And if you look at it critically, all the while, inflation has been on the uprise movement. And so it simply means that we've been holding our hands and we are now actually fighting inflation. So I feel that to show that we are really serious to actually fight this battle, I was preaching around the 500 basis point rate hike at a time when I saw the rate that we naira was implementing. So seeing a 400 basis point, I think is actually reasonable. And also you also understand that the post-MPC meeting, the CBN governor also mentioned that the meeting for March will be more like evaluation, and if there's any reason at further tightening, they will actually told that, and it makes a lot of sense because we'll actually see more of a credible impact between the last MPC and now. We'll see naira stabilize around 1,600 as we speak. Of course, based on the report that was released, it shows that from their perspective, it's like naira should be around 1,200 by the end of the year.
All right, I guess we'll have that conversation, very close to the meeting. But look at this now. For me, if you ask me, I'll say this is a two-way street. And interestingly, even the MPC acknowledged the trade-off. However, isn't it also concerning that these same decisions have effectively withdrawn liquidity from the banking system? Talk about the last auction that we had, and I've heard some guys, some banking folks talk about the fact that that auction actually essentially mopped up cash from the banks. And I fear that this might affect their financial intermediation role, as some unethical banks might just keep, playing in the fixed income market rather than give credit to the real sector. I mean, I know you might want to talk about the LDR, but of course, anybody can decide to do anything. Let me get your thoughts on that.
Yeah, if you know before now, sincerely speaking, what the central bank just did was to regularize. Because they have opportunities to remove banks. Some banks were already at about 50% LDR. So it wasn't systematic, it wasn't flat across board. But what the central bank just did, or what the MPC did, was to actually create a straight benchmark across board for all the banks. And I agree with you that will take a lot of liquidity from the banks, and what it will also mean is that actually granting loans to the real sector will actually be affected. I so much agree with that. But if you look at it critically, in a situation whereby you are fighting inflation, the first thing you want to take out is you want to take out consumption, and you want to actually push people from the area of consuming to the area of investing. I do also agree that current inflationary pressure is two-sided. We have the demand pull, we have the cost push aspect. And the demand pull aspect is the one that pertains to the monetary policy gap. And that's why they are currently focusing on it aggressively. And actually, it won't be effective when you actually take a rate up and at the same time you are leaving liquidity in the hand of banks. What it will mean is that you are giving room for banks to actually come into the security market and come and invest such funds. And what that will mean is that rates will automatically drop, and it means that you will be fighting consistently pushing rates up, while at the other hand, the banks will be using the liquidity to actually further depress rates. So in a time where you actually want rates to actually to a reasonable time be static at the level, you have to start the market of liquidity, and that's exactly what the central bank is currently doing.
Let me come in here, Oladipo. All right, I like how you've talked about, how it affects banks or the banking sector. What about the real sector, the ones who will be starved of, this credit? What about them? Aren't we, shouldn't we also be looking at balancing all of these? So on one front, we're doing something, maybe we have another, maybe the fiscal authority doing something else, on the other front. What are your thoughts on this?
Yeah, I think that's the angle where the target program now has to come to place. The central bank needs to do its bit. Maybe it's now have to be in the confines of the fiscal policy guide now to now target, create a target borrowing lending scheme to specific sectors. Because as we are currently, it's because we still have a country that where we are talking about growth and inflation. If we are not very careful, we'll get to a level where we'll have runaway inflation. And at that particular point,
how close are we to that point? How close are we to that point?
No, we are still far from the point because currently, as we speak, we still have what we take, what we need to actually handle the current situation. And that's exactly one of the reasons why we are seeing the CBN governor becoming more hawkish and to actually rein in the current inflationary pressure. Imagine that we don't, the CBN governor didn't quickly standing in this situation, and naira has gotten to maybe 1,200 or 1,500 as we speak. You also know that there's also the effect of exchange rate that normally will filter into the inflationary pressure. So we need to actually first of all salvage this situation. And for me, at the beginning of the year, it was crystal clear. The CBN governor has mentioned it, that the H1 for the year will be hawkish. So it simply means that organizations, they should have been prepared for this. And it's just a matter of time because I see by H2 we start seeing moderation. And by H2 I expect the MPC, I expect the central bank to start toning down on the current level of hawkishness they are currently disposing in the market. So I agree with what the central bank is currently doing because we need to salvage the country as we speak. And the ball is now in the court of the fiscal policy guide to find a way to create a scheme that will target some of these real sector players that they know that they have great impact to actually give to the market, and that's exactly what needs to be done.
All right, still looking at the rate at which the CBN has been going to the domestic debt market. We might as well also probably begin to look at the crowding out of the private sector from the market, because when you look at the real rate returns, it's encouraging for us to have about 80% foreign participation in the last one we had. What are your thoughts about this? Are you worried? Is it something we should be worried about?
Yeah, I'm actually worried about that, because it makes it more expensive for private companies to actually access the debt market, and that's why timing is also very essential for private organizations. You need to understand the architecture of the economy. You need to understand what will happen in the economy, because that gives you a very good opportunity to know the right time coming. I feel that I'm sure I mentioned in one of my programs with you guys that January is a big window for any private organization that wants to go into the debt market. Because we know from February up to the maybe by the 7th month of the year, we expect the central bank and the monetary policy to actually show up a more aggressive policy that will impact the market, and that's exactly what we're currently seeing. So I think that this is a time for you to actually just get more like a short dated borrowing to augment your book. It's not a time that you have to actually take a loan of 7 year or raise a 7-year debt or raise a 10-year debt. This is more like you have to play more in the short market, like the commercial paper market, where you can actually raise funds of 270 days. So that at the end of the 270 days, you can roll into a cheaper funding for your business. Because as we speak, rates are actually very expensive in the market, because if government paper is already giving people close to about 27.3% level effective yield, of course, a lot of people will actually want like a 30% from a corporate organization.
All right, let's get back to the report. It talks about the ongoing monetization of the fiscal deficit, saying it contributed to an increase in inflation to 30%. That's 29.9% year on year as of January, as well as a sharp currency depreciation. I'd like to get your thoughts on that.
Please, can you come again? I can't hear you clearly.
Okay, so I was talking about one of the things that this particular report said, saying that the ongoing monetization of the fiscal deficit contributed to the increase in inflation as well as a sharp currency depreciation. I would like to know if you agree with this particular statement.
Yeah, we all agree to this because several times analysts have come around to say the ways that many fund treated them actually contributed to where we are going. And I think that's one of the reasons why you've seen the central bank being more aggressive in actually taking liquidity from the market so as to actually reduce the impact of the current inflationary pressure in the market. And also, what that will do is that will also spare the current volatility in the exchange market, because it simply means that what you are doing is that you are making naira scarce so that naira can be purchased, and that's exactly what's happening. So they actually are totally wrong. Goldman Sachs, they are actually very right rather with their reports around that, because it's something that is very clear. Because when you print that kind of money into the system, of course, what you expect to see is exactly what was print. And funny enough, it's not peculiar to Nigeria. We saw that happen in the US as well. During the funds printed by the US during the COVID crisis, will actually work well the inflationary pressure that they actually went through in 2023. And you saw how the US Fed, how they were very hawkish over time until when they start seeing results. And I think that's exactly what the current CMA government is currently doing. And that's why I mentioned that his focus, his policy will be inflation targeting. Because if you don't do that, you will continue to reduce the value of your currency.
All right, just before you go, the CBN is scheduled to hold a Treasury bills primary market auction today. What do you think investors will be looking at? What are we looking at in terms of rates?
I think currently both parties have shown their cards. We saw what happened at the last Omo auction. 1 year instrument actually cleared at 21.5%, effective yield of over 27%. And also, just days later, the DMO through the central bank also replicated the same thing, where they closed the 1 year at 21.49%, almost the same effective yield. So for today, I think for what we'll likely see, we'll see that repeat as well, because it's already now looking like more like a window that's actually attracting foreign investors into the market, and I'm sure they want to maximize.
All right, so do you think 12 months is too long for the naira to appreciate to 1,200 per dollar? I mean, that was one of the top stories, or let's say the key highlight of this particular report. What are the catalysts that will spur this appreciation or even hinder it?
I think 12 months is too long. That they just gave you on the horizon, and basically that's how it works. When you are given a projection, you give more like a 1 year window, and that's exactly what Goldman Sachs did. They gave you was like a window, but this is something that can actually happen within the space of 2 months, 3 months, or even less than that. It depends on the policies that currently.
And is it going to remain stable there? Is it going to be stable? Aren't we going to see another fluctuation?
Yeah, no, I think now, I think we'll see more stability than where we're at now. I think the next thing we'll start seeing is naira appreciating from where we are currently trading. Because one way is that we'll be seeing the influx of foreign investors in the market, and that's one of the things that can help us pushing the trend and help naira to actually appreciate.
All right, thank you so much, Oladipo Ajayi, Head Fixed Income and Forex, Chapel Hill Denham Securities. Thank you for sharing your thoughts with me today on Business Edge.
You're welcome. Thank you very much for having me.
All right, we'll take a break now. When we come back, we'll bring you international business headlines. Stay with us, don't go away. The UK economy showed signs of recovery as it returned to growth in January, raising hopes of moving out of a shallow recession. Gross domestic products increased by an estimated 0.2% in January, following a 0.1% decline in December, driven by strong retail sales and improved activity in the housing market. This rebound suggests that the UK may be turning a corner after experiencing negative growth in the fourth quarter of last year. However, the overall economy contracted slightly over the past 3 months. Chancellor Jeremy Hunt highlighted the progress made in growing the economy and reducing national insurance contributions, but emphasized the need to make more work rewarding. Japanese companies have fully accepted union pay demands, indicating the potential for workers to have exerted more pressure. This also suggests that wage momentum could prompt a significant policy shift by the Bank of Japan, while global expectations for rate cuts are being pushed back due to higher than expected U.S. inflation there is increasing speculation that Japan may end its experiment with negative interest rates, which play a crucial role in reinforcing Japanese spending and confidence. Notably, Toyota Motor witnessed the largest pay rises in 25 years, contributing to a sustainable economic revival in Japan. Additionally, there are expectations for British GDP and European industrial production figures, while the Bank of England rate cut is not fully priced in until August. Asian shares reached 7-month highs on Wednesday, shrugging off slightly higher than expected U.S. inflation. Investors bet that it would not derail anticipated interest rate cuts. A Reuters report earlier in the week about increased financial support for developer China Bank also supported Hong Kong stocks. MSCI's Asia-Pacific Index outside Japan rose 0.2% to its highest level since August. Tokyo's Nikkei was steady, with attention focused on springtime wage negotiations. U.S. Treasury yields rose after the inflation data, leading to record highs for U.S. stock indexes. The dollar received some support from higher yields. Gold prices retreated, while crude futures remained range-bound. Oil advanced after 4 days of losses as an industry report pointed to shrinking U.S. crude stockpiles, offsetting wavering OPEC cuts. West Texas Intermediate futures rose to trade near $78 per barrel after falling 2% over the previous 4 sessions. Brent climbed above $82. The industry-funded American Petroleum Institute reported crude inventories slid by 5.5 million barrels last week, according to people familiar with the story. That would be the first drop in 7 weeks if confirmed by U.S. government data later Wednesday. The API figures also showed crude stockpiles at Cushing, Oklahoma. The delivery point for WTI fell by almost 1 million barrels. These are the international stories we're tracking at this hour. We'll take a break now. When we come back, we'll bring you our next conversation for today. Stay with us, don't go away. Glad to stay with us. Africa's biggest bank, Standard Bank, is predicting a stronger growth rate of about 3.2% for Ghana in 2024, higher than that of the International Monetary Fund, IMF. The fund had earlier projected a 2.8% rate for the country. Joining me to unpack this is Paul Frimpong. He's a development economist and the executive director, Africa-China Center for Policy and Advisory. Thank you, Paul, for joining me today.
Thank you for having me.
All right, so let's look at this now. We have Standard Bank's projection, which is about 3.2%, and that of IMF is 2.8%. Which of these do you align more with?
Well, I think it's very I think I'll just be in the middle there.
Okay.
Of course, there are some of these numbers keep coming up as and when they monitor certain developments that are happening. I think the Standard Bank's own is highly optimistic. I believe it's so much optimistic in terms of what the economy can actually grow to become. The IMF one is more cautionary, very conservative in that respect, because they know what they're dealing with. They are already deep in the hands with the Ghana government, because we are currently under IMF program. So they really, I believe, understand the dynamics in terms of what is on the table, what the country has been dealing with, the country is dealing with, and what could potentially affect the country's potential growth in this year. So I believe that whilst I know the IMF one is conservative, I believe that the Standard Bank too is too much optimistic. I believe in the middle we can strike a balance there.
Okay, so let's look at this particular growth now. The growth is actually premised on the services sector, so I think we just need to pay attention to it, because looking at figures from 2022, the share of the services sector in Ghana's GDP was about 42.03%, and I believe there is room for more. So what are your recommendations for deepening this sector so we can probably hit that optimistic projection?
Yeah, even the government budget for 2024, the projection is that the service sector is looking about 6.3%, even as of Q2 of 2024. So I believe that it's all in line with the fact that the service sector has been a huge contributor to Ghana's growth, of course, followed by agriculture, which is very essential. I believe that if we can pay more attention to that sector as well, we can actually be able to boost the growth. So I believe that they're all in line in terms of government projection for the year. and of course what the IMF and the Standard Bank is also projecting. There are a lot of nuances happening in the Ghanaian economy as we speak. In the beginning, I think the government changed most of the happenings on, of course, first COVID-19, and then you talk about the Russia-Ukraine crisis. But now it's beyond that, because you look around the world today, there are a lot of geopolitical happening that could easily influence or impact what is happening in Ghana, especially what happens to the U.S. economy is very essential. What happens to the Chinese economy is very essential. All of that can actually affect, what we are expected to happen in Ghana in the years to come. So I believe that the government earlier on, as I said, was dealing with some of the issues. Now we're talking about a lot of, instabilities in the Ghanaian economy. There are a lot of price hikes. Inflation was all-time high a couple of months ago. It's still very high, double digit, in the highest of double digits as we speak. So the governments, have to be, very strategic to try and diversify as much as they can, and not rely on one sector being a huge contributor to the growth, like the service sector. I think there has to be a room for diversification. Make sure that there's a boost in all sectors so that they can offset each other in case there's any shock in any of the sector that's hugely contributing to growth.
I like that you've actually focused on two sectors, but beyond these two sectors, are there other sectors, that have the potential to deliver good numbers? And when you're talking about diversification, I'm sure sometimes you have to pick out one or two sectors, to say these are the areas we want to focus on or pay attention to. What would be your own recommendation?
I think it's just about two of the other sectors that I believe has huge potential. One of them, the tourism sector. I think Ghana has a rich history and endowed with very amazing, tourist, sectors, destination that can actually become a huge potential. Again, we are providing a very stable environment. As you can see, a lot of people are staying here, expats are staying here, and a lot of potential to host some of the leading conferences and forums in the region, and all of that can boost the tourism sector in terms of hospitality, sector as well. So I believe that the tourism sector is very key. If only the government can be very strategic in providing the right resources and policies and programs that can attract. In the year, I think in 20. I think prior to COVID, we had a year of 10. It was very massive. I'm sure maybe you guys discuss about it, where the government ran a global campaign of trying to get people in the diaspora to visit Ghana, to return home. And if you check the numbers in terms of the boost to the economy within that period was very much. That shows the potential of the tourism sector for the country. The other sector I want to look at is the creative industry sector, which has not been tapped, really much. I believe that also has a huge potential. I mean, if you pick a case that even the sports sector, let's take the football, as we all know, Ghana is a football country. At a point, I think last year, a report that I glanced my hands on was that Ghana was among the top 5 exporters of football talent to Europe and other parts of the world. But then when it comes to earnings for the country, we were not even among the top 50 countries that earn most from football. So we are the top 5 exporters of footballers to the rest of the world, but we're not among the top 50 earners, top 50 earners in terms of football. I believe that these are things that are going to be policies and programs and governments being conscious of what the country can do in terms of that. I mean, look at the talent that we have. You can actually manage it, develop your coast football system in such a way that you're going to export more talent. All right. And that can generate a lot of money. So I believe that these two additional sectors can be a game changer for the country if they're able to put the right policies and the government can focus on it.
All right, you talked about, maybe something, or if one of the factors that can actually pose as risks to growth. And what you talked about was geopolitics. So is there something, Ghana can do, to mitigate the risks, when we look at geopolitics? Because when you look at even El Nino, really. So when you look at El Nino and then you look at geopolitics, these are some of the things you might say that the country doesn't necessarily have control over. But how can these risks be mitigated?
I think we just have to be strategic in our alignments. In terms of what we do out there, which with all countries, I believe that we have to widen our net and strategically look at the interest of all parties that we are dealing with. I think it's very key, and not to be boxed into trying to take side because of what need to do. We have to be strategic in that. We have to take a position that as a country, this is where we are, this is where we are, our priorities are, so that we don't get ourselves entangled in any other geopolitical happening. For example, issues about the Russia, Ukraine, the US, China, trade wars. We need to be strategic about some of these happenings and make sure that we are not caught up in the middle of a war or some trade theft that we are not part of. But we have to always be looking out for the interests of Ghana, the interests of our country. The issue about even digitalization going on, where we believe that as a country where we are, for some of us, we believe that we need to be strategic about the dominance of the US dollar and other major currencies in the country. It's about time we try to move up the value chain in terms of trading with partners in local currencies. That way, it reduces the pressure on our local currencies, which again leads to inflation and all of it. So I believe that we have to be studying some of these things, and the era where the country will be forced to take side for any other country should come to an end. We need to decide for ourselves that at this point, this partner, the interests of this partner are left interest, and therefore with this partner, not because we are under a certain obligation by another partner to take side. I believe these are things that we can do so that we can limit the risk of geopolitics going forward.
Rightly said. I would have loved to hear what you have to say about El Nino, but let's leave that there because we're pressed for time. Historically, I would say Ghana's economy has been expanding by 5% year on year until COVID happened. Yeah, I mean, so how soon do you think Ghana can get back to such levels? Is it something that can happen anytime soon, or what are the things that must be in place for this to happen?
Yeah, I think I'll put it in the medium term. I don't think in the short term we are going to really be back, because we've been through a deep hole and a lot of things to recover before we can get to the pre-pandemic levels of 2018, 2019. We are dealing with a lot of issues now. The country is now under a 3-year IMF program, as you know. So at least in the medium term, unless we are kind of exiting from these kind of IMF, bailout, to be really ensure that we can project a very credible economy that is very resilient, that can attract a lot of investment. Until then, I believe that it's going to be growth, that is not going to be exponential. We're going to see gradual, growth going forward. I believe that even now, we are still not even done with some of the restructuring that we are doing in terms of the external debt restructuring that the government is still going on with the official creditors committee, with the international bondholders, and all of that. I believe that all of these have to happen first before the country can confidently say that they're on their path of full recovery to the pre-pandemic level.
Absolutely. I won't let you go without, talking. Okay. Can I go ahead now? Okay. So I would like to go without putting this there. The Ghanaian government, in collaboration with the National Communications Authority, is actually in discussions with the Gambia and Benin, that's the Benin Republic, to introduce free mobile roaming services. How impressed are you about this, and what could be the possible impact of this move?
I think it's all part of the drive for as a continent, that it has to be a way where we can do business across borders very easily. There are a lot of constraints, a lot of restrictions as a continent, where even among ourselves, communication is very limited. I believe that these can all be a part of the drive under the Africa Continental Free Area, under the Agenda 2060 of the African continent. And this summarizes the framework of the ECOWAS, because there are a lot of things that we can actually harmonize. There are a lot of things that countries we have the political will can do to ease the rate of doing business across the continent, across the region, to actually fast track how businesses can communicate. There are a lot of solutions that can be put to the table to eliminate, the non-physical barriers, as we say. So I believe that this is a step in the right direction. The government in the region can stay committed to some of these technology innovation that can help bridge the gap in terms of trade and people to exchanges. I think it's a welcome development. I believe that, as the government, the vice president said, something already signed with Togo and with Benin, and of course with Benin and other Gambia. I believe that's something that can be expanded across the region, and that will help, and can contribute to the continent's own vision of connectivity.
Paul Yofrimpong, Development Economist and Executive Director, African China Center for Policy and Advisory. Thank you for your thoughts on the show today.
Thank you for having me.
But that's it on this edition of Business Edge. You can follow us on social media. We are at News Central TV. You can also go to our website, www.newscentral.africa. You can download our mobile app on Play Store and on App Store. Till next time, I am Perpetual Fasnmi-Peter. Bye for now.